In this last video for chapter 16, we want to think about what does the model say would happen with a fiscal contraction, right? Deficit reduction. So either we're decreasing government spending and or we're increasing taxes. Because the model says one thing, and then we're going to look at a little bit of data right at the end that kind of says something else. And so this is one of the big debates that's going on in macroeconomics in terms of what happens when the government decreases spending and or increases taxes. The model says that should be bad for growth, and the data says, well, that's not so clear. And so we'll look at data from the European Union after the financial crisis, and we'll see that governments that did follow fiscal consolidation or fiscal contraction experienced lower growth than they expected, right? And so the pushback over the last 10 years has been, okay, well, that didn't work. Maybe what we need is, more government spending and fewer taxes, which is easier in a country like the United States that has its own currency than it is in a country like Spain or Italy or Greece, which is on the euro. And so they share a currency. And so they share a monetary policy with countries like France and Spain, which might not be ideal. So let's think about what the model says first. And we say, okay, well, it's a little bit unclear, right? Because a decrease in government spending should shift our IS curve to the left, but a decrease in the real interest rate and an increase in output, expected output and expected real interest rate should shift it to the right. So that's unclear, right? A decrease in government spending could do either one. Whereas before we said a decrease in government spending should shift it to the left. So we want to think about sort of what would go on, right? So how should you reduce government spending and or increase taxes? So the first issue is timing, right? So credibly backloading. So backloading means doing more of the deficit reduction in the future might be better because it might have less of an effect on current output. So, for instance, you could pass a law that decreases government spending by a small amount now and then by a larger amount in the future if you felt you needed to decrease government spending, or the opposite with taxes, right? A small tax increase now and an increase tax later. But the credibility of that is really important. And of course, the problem with any policy and any law is that it can be changed. And so if we get to 3 years in the future where government spending is supposed to be cut by a significant amount or taxes are supposed to go up by a significant amount and is very unpopular, then the government might change its mind and go back. Obviously, the composition of what you cut is going to be important. So if there are government programs that are wasteful, cutting those would be better than cutting government programs that are productive. So, if we think about the most productive government programs, it's going to be things that increase investment, increase human capital, so education, roads, any kind of infrastructure, the electrical grid. Obviously, these can be, more efficient or not. One of the problems in the United States that we face is that our government construction programs, whether we're talking roads or bridges or whatever, tend to be much more expensive than in other countries. And so that means that we get less bang for our buck. But also, the expectations of lower taxes are going to be important. If we say, okay, we can cut government spending and therefore we're going to lower our taxes, obviously the balance between those effects would be very important. The other thing is the initial situation, right? So, cutting, if you have a surplus, obviously it's easier to have a fiscal contraction than if you already have a big deficit. That said, it's really unclear whether, the deficit and the debt are super important for countries like the United States, like Japan, which have both seen their deficit and debt increase a lot. And it's not clear that it's had such a big effect on economic growth and economic output. And then, of course, there's monetary policy, right? Monetary policy is going to be very important because, if you think about, say, the 1990s in the United States, we actually were going through a fiscal consolidation. We had increased taxes in the early 1990s, and sort of throughout the 1990s, we decreased military spending due to the end of the Cold War. And one of the ways that we offset that was with a more expansionary monetary policy, right, with low interest rates. And of course, there's been some criticism about those low interest rates because they lead to increased asset values, as we saw in Chapter 14. And so they may have contributed to the dot-com stock bubble. And then in the next decade, they almost certainly contributed to the housing bubble. And so how much monetary policy can offset the change in fiscal policy is going to be an important question. And this is, of course, was an important question in Europe, where they don't share a lot of fiscal policy, right? There are a few things that they share on that side, but they do share a monetary policy, right? So the interest rate is set by the European Central Bank because they're all on the same currency. So here's an example where Ireland cut its budget deficit fairly significantly. So from 13% in the early 1980s to about 2% in the late 1980s. And GDP growth, it went down and then it went back up, but the unemployment rate was quite high, right? And so it's not clear that that was a great thing for the economy. The unemployment rate went from 9.5% to 17% before starting to come down to 15% by the end of the decade. It also reduced household savings rate. And so, maybe it was good in the long run. A lot of Ireland's growth recently has come from being a sort of tax haven for American firms, especially, which is not clear that that's really a great model, because you get GDP growing really fast, but GNP, which just measures the sort of income of the Irish, has not been growing as quickly. So I'm not sure this is a great example for, saying that deficit reduction is a great thing. 9% unemployment is better than 15% unemployment. So really the question comes down to whether or not fiscal multipliers are large or small, right? And so if fiscal multipliers are small or even negative, right, as some people argue, then smaller deficits could lead to an increase in output. But if they are positive and potentially above 1, right, as we did measure at the end of the financial crisis, then smaller deficits would actually lead to a decrease in output. And so it's always important to remember that, the deficit of a government is not like the deficit for, a person, right? If you consume more than you earn, that's not sustainable in the long run. But a government debt is sustainable because the government never dies and they can roll over the debt, right? When it gets into trouble is when people don't think it's going to be able to pay back its debt, and therefore interest rates start to rise, and it starts eating up, the interest payments start eating up a larger and larger piece of the government's debt. And so we've seen that, and that's what leads to defaults. But as long as interest rates are low, then it's not clear that deficits and debt are having really any impact on the macroeconomic situation. And so here is our last slide, where we can see that we had the forecast of fiscal consolidation. So that's how much they were sort of reducing their deficit. This is for Europe in 2010 to 2011. And this is their growth forecast error. So this is more fiscal consolidation. And you can see Greece was over here on one end and Germany was over here on the other end. And then this is their growth forecast error, right? So how much did they miss their growth forecast? And you can see Greece missed it by a lot. And Germany actually grew faster than expected. And so this really suggests that all of the fiscal consolidation that was sort of forced on countries like Greece and Ireland Romania was not necessarily a good thing and actually led to slower growth, although Ireland does look a little bit like an outlier. So I think this is important, and it's going to be important for the United States as we sort of move forward from the COVID pandemic. Actually, the author of this textbook, Olivier Blanchard, has been one of the people who's been saying that we're doing too much, and that's going to lead to inflation, and we're going to have to raise interest rates, and it's going to be a problem. Whereas other economists have been saying, well, there's a little bit of risk there, but the bigger risk is not doing enough. And so better to do too much than too little, and monetary policy can always cool off the economy by raising interest rates if necessary. So this is going to be very interesting as we recover from COVID-19, because we have a lot of saved up money. I think there's a lot of pent up demand for various goods and services. And so it'll be interesting to see if that starts leading to higher and higher inflation. Paul Krugman feels like, we might get a blip in inflation, but it won't be something permanent. So it'll be interesting to see.